Hello everybody, Jim Malone here from Dallas Trading Floor. Happy Wednesday. I have a very interesting put spread on First Solar. It's an interesting stock. You wouldn't think it would be moving higher, but it has an extremely good chart. I want to take a look at that in just a second and then kind of show you what I'm doing, how I'm proceeding with this credit bull put spread. Take a look at the chart of First Solar to my right. You'll notice we're coming out of this cup. And we did gap up here, very nice gap up. And you'll notice that the relative strength right now is at a 97 on this chart and a 99 composite rating. That means that right now First Solar is in the top 1% of all stocks out there. So very, very strong. It's also the first in the group, so we definitely like looking at the leader. And today it closed up $1.45, or about 0.5% up on the NASDAQ. It fell off a little bit in the after hours, but overall, very, very strong stock. When considering any trade, we need to look at the market trend. And currently, the market is in a confirmed uptrend, so it's very, very good. Typically, the stock market exposure should be in an average portfolio about 60 to 80%. I know that I'm a little bit below this right now because I did sell today my position in NVIDIA, taking profits, waiting for some good opportunities in the market. But 60 to 80% is kind of the recommended amount of investment in a market that is in a confirmed uptrend, which we are now. The industry group of the First Solar is 22. This is out of 197 groups. And the group relative strength is an A, which is, it doesn't get any better than that. So, oddly, I would never pick a First Solar, but the charts don't lie. So that's why I'm definitely in this trade. Here's how we did it. The way we entered this trade is we first bought June 21st 245 puts, and we paid $226 for that. And then simultaneously we sold the 250. So you can see we have the protection at 245. We sold that 250, and we did 5 of these contracts. We got 301 for the 250 put, giving us a total, if you net it out, $375. Now the way these credit put spreads work is the money goes into the account immediately, and then we try to either hang on to it till it expires or close it early, hopefully for a profit. So typically we want to close it for less than $375. So it's kind of interesting how it does work. The maximum risk on this, if First Solar were to move to 245, this would be going on the downward slope, would be 21.25. Now hopefully if this was a trend, we would be closing before then. The maximum return on this, of course, is the amount of money that we receive when we open the trade, $375 for the 5 contracts, and of course that is if First Solar were to expire, and that is after June 21st at 250.01, so right over 250. If the stock stays above 250, we're going to keep all the money there. Our return, about 17.6%. That's what I am estimating, or about 268% per annum. And of course, the break even on this one, 249.25, and that's going to be right above where we hit the maximum return. Probably profit on this one, I'm calculating about 81.2%. So pretty high on that probability. Please remember that options are risky, and investors can lose 100% of their investment. This article is for educational purposes only and is not a trade recommendation. Remember to always do your own due diligence and consult your financial advisor before making any investment decisions. Now back to the show. Here's how I'm doing the trade management. Now, of course, today we're right about here. The stock was about 277.50, as you can see. We're right about in this range. If we were to just flatline and can stay flat here, eventually we would get to June 21st, and we would not close the trade. We would just keep it all the way to the end, and it would expire. And, of course, we would keep the premium, which is the $375. Now, if the stock moves up, of course, we can possibly even close it earlier if we get this nice upward motion. Now, the problem, of course, comes if the stock does fall, and there we could get into a situation where we did have to close early. Here's an example of an early close, and this is kind of how you want to maintain your trade. If, for instance, we're drifting down and we need to close early, now, by the way, there are other things that we can do. We can also, we could also go up and out, or if we had to. But just if we had to close, this is how you would do it. You would essentially reverse your trade by selling the 21st 245 put that we bought previously, and at this point we're estimating that price would be 356, or if you multiply that times 5 contracts, 1780. And then buying back, you need to buy back the contracts that you sold, the June 21st 250s, at 5 of those at 483. This is the estimate of the price would cost us $24.15. So if you net them together, it would cost us $635 to close the trade at this location, and that would be at about at 265, right about here. But if we maintain the same slope here, and we don't fall below this line here, we can probably go all the way to the end. If we did close it early, of course, we would pay for it, and we would lose $260 on this trade. But what I plan on doing, of course, is to basically setting a stop loss here, and if it does fall below 250.50, that's where I would close the trade. Other than that, I'd probably leave it open depending on how the market was trending. So if it trends up, of course, we could close it early if we get to about 90% of the profit here if we were to go up this way. So this kind of gives you an idea of how it would look. Here is the kind of the risk profile of the trade. On this graph, you can see we entered the trade right about here. We're at about 377.50. That's kind of where we are right now. If we just continue to just flat line on this, as we get closer to the June 21st period, you can see it moves up here. So as long as it stays kind of in this upper area above 0 here, this is going to cost us, we're going to make money on the trade because we're going to close it, if we close it early, we're going to close it at a profit. Now, of course, if it falls below, and this would be 277, you can see it would cost us to close it. But as time goes forward, it's going to be less expensive to close it as the options decay. So kind of an interesting trade here. Just wanted to show you that. And also, hopefully I will give you an update on this trade. I'm actually in this trade myself, and so hopefully I'll give you some updates on how we are managing this trade. If you like these kind of trades and would like to see more of them, you can join Dallas Trading Floor free. Just scan the QR code to my right, and you'll be taken right to a landing page where you can put in your information. And of course, it's always free, and you can discontinue it anytime you like. So it's free, and we show you other trades here at Dallas Trading Floor. Hope to see you back here soon. This is Jim Malone signing off for Dallas Trading Floor.